We are going to get started in a bit of an action-packed webinar this morning. Before we get stuck into the meat of it, I'm going to run through a bit of an introduction and some events that we've got coming up. So, yeah, here we go. So, if this is your first time joining one of our webinars, my name is Ben Walker and I run an accounting firm, Inspire Accountants, based in the Fortitude Valley. We work with business owners all around Australia. I can see just by the attendees, I recognise quite a few names there, and they are definitely spread throughout the country, which is kind of cool. The other thing which the team updated me on this morning is that we're up to $28 million in tax savings. I think we've saved around the $1 million mark just this week alone, which is mind-blowing. We're in the middle of tax planning, yeah, it's coming to an end, but a big season for us where we're able to do this work with clients. Alrighty, and another event that's coming up, which is actually in a few weeks, so it's in around the middle of July. Yep, the 12th of July. There we go. I'm hosting a webinar with Sean Sewell, and the topic is how to go from stuck to freedom in your business. So Sean Sewell is a business coach. We've got quite a few mutual clients, and I love his perspective. In terms of taking a business owner who's sort of really stuck in what they're doing, extracting them from operations and that sort of thing, and able to sort of spend more time on the business, not in it. So there's a few things we're going to run through on that. If you do want to join, there's the QR code if you've got your phone handy. Otherwise, there'll be a link in the chat box any second now to register for that one. Alrighty. Also, if you do want to explore working with us as your accountants and you're not currently doing that, then the way to do that is to book in for a strategy call with one of our accounting team. You can do that with, again, a link in the chat box shortly, or inspire.accountant/chat if you do want to have a conversation with one of our accounting team. And yeah, I mentioned my name, Ben Walker, earlier, but I started Inspire when I was 23 years old, which was about 10 and a half years ago now. I'm an award-winning chartered accountant with 17 years of accounting experience. That seems heaps, but yeah, maths is maths. And the author of Wealth for Life, which I'll talk about later in the webinar as well, and the relevance for that book in self-managed super funds. And this is a couple of photos of my beautiful family. Cool. All righty. Well, what are we going to be looking at here? Sorry. Might shift gears into the actual webinar topic, which is on self-managed super funds. But first of all, like why am I actually sharing this stuff? So there's a couple of points here. I've personally been a member of a self-managed super fund since 2011. I've looked after hundreds of SMSFs over my career, including auditing many SMSFs when I started working in KPMG. So one of my first projects for 6 to 8 months was actually auditing self-managed super funds. So I kind of got to learn how they worked from right at the start of my career. Around about 60% of Inspire's SMSF clients hold some sort of property, whether that's direct holding or with loans against it, or they own property held in other trusts, that sort of thing. So, yeah, I pop that in there just because usually there's a conversation around property when we're talking about SMSF. It's not always the case, but definitely is a big reason why people explore looking at them. I've been an advisor on many purchases and restructures involving super. It's something I enjoy. It's a bit of a specialty of mine and our team that we're able to sort of help clients with, doing this sort of stuff, carrying out property developments. You might even have a related party builder involved and making sure you tick all the boxes with the tax rules and superannuation rules. Yeah, it's kind of fun. And around 28% of our clients have an SMSF. So not everyone does, but I'd say that's actually, that's surprising that almost a third of our clients run one. And just looking at the sort of numbers from an industry perspective, the ATO publish stats each year on key SMSF stuff. And the year ended June 22, there was 27,000 establishments, SMSF establishments. So that's more than 2,000 a month that we're getting started. It's not the highest year. Obviously down here is quite high. And we've got, but see the wind-ups have also dropped off. So the net establishments, if we look on this column here, is actually the highest it's been in ages, which is kind of cool to see. Another interesting stat is the average and median SMSF balance. So this is per member, and then you've got a per SMSF. So this has also increased. We've got older years over on the right, and the most recent stat they've got is the year ended 21, because the reporting period for 22 is just coming to an end at the moment. So they probably won't have the data for a couple of more months, but the 21 figures were just shy of 800K per member, and we're looking at just shy of 700 in 2020. So that's actually a big increase in that year, which I don't know, it's interesting. That was when all the COVID drama kicked off. And then the average assets per SMSF is roughly about twice that. So that kind of says to me that there's roughly 2 members per SMSF on average. And then looking at the whole SMSF balance, again, these are June 21 stats. If we have a look at this table, hopefully it's big enough on your screen, but here, I guess the circle is looking at funds that have more than $1 million. This is actually an interesting stat. So I looked at last year's, and 24.3% of funds had more than $1 million in it. A year later, June 21, that figure almost just shy of doubled, but 42%. So it's a huge increase in millionaire funds. Yeah, pretty interesting. And I mentioned the Wealth for Life, the book that I wrote, which was published in September last year. The step 6, if you've got a copy of the book, there are some people with a copy, which is kind of cool that I see attending. But if you've got a copy, step 6, long-term wealth, talks about superannuation in a lot more detail than I'll go into on the webinar. It's a bit more comprehensive. So if you do want to have a look at that, then feel free to do so. If you do want a copy of the book as well, here's how you get it. There's a link down there, or Tay, if you could just pop that in the chat box as well. If you do want a copy of the book, we can mail out. So in terms of the other content I've got to cover, I'm going to run through the 8 benefits of an SMSF. And we've got engagement, family fund, the ability to control taxation, discussion around an investment strategy, leverage or lending, insurances, things to keep in mind, incapacity planning, and estate planning. So they're the kind of key topics we're going to have a run through today. And the first one is engagement. And what I mean by engagement is how connected or aware of your own superannuation are you? From my observations, people with SMSFs are a lot more connected to that, that they know what they're investing in. But some questions, you know, maybe rhetorically you can ask yourself is, how much do you or your spouse have in super? So if you can't guesstimate that, that tells me that you're probably a little bit disconnected from your super. Which fund is it in, or funds, if there's multiple? We had a client recently that had, I think, 10 superannuation accounts between husband and wife. So that was huge, but a lot of small balances. So yeah, that was interesting. In the process of getting fixed up. And then, is that fund making a return you're happy with? You know, do you know what it's invested in? Are the returns okay? They're the sort of engagement questions that, again, I'd say on average, more SMSF members would be able to answer because of the the requirement to be involved in managing it. Cool. And then the other thing that's important, or the question that always comes up, is comparing your current super to an SMSF. It's like, why should I? Why should I consider an SMSF? And I guess it obviously depends. You know, what's your current super performance? What do you actually want to invest in? Because if you can get the same investment outcome without the structure of an SMSF and the admin that you'll need to do, then there may not actually be quite a strong point. And then what's your current balance? So I was actually having a chat with my PT this morning about the webinar, and they asked a question about what's the minimum? And I said, well, there's actually no minimum. There's no legislated minimum that you need, but the guide, like if you Googled that question, you'll probably get answers between 200 grand and 250K. I've been saying that for a while now, so maybe adjusted for inflation, that's probably closer to 300. Now, when I'm answering that in terms of that range, that's more from a break even on your costs to run the SMSF versus the costs you're paying in your whatever your super's in now, your non-SMSF. But again, we've got clients with SMSFs that are lower than that because maybe they want to put a deposit on a property or buy their own commercial property. They don't need a big balance. They can do that with 100 grand, let's say. Now, yeah, again, I'm not saying we all run out and do it if we've got 30 grand in our super, but I just think there's just no hard and fast rule. It's more about your intentions, what you want to do. And even someone with $1 million in super may actually not be better off in an SMSF depending on what they want to do. All righty. And just another, I mean, I kind of said it before, but just something else I want to sort of remind people when considering an SMSF is that the SM in SMSF is self-managed. So it requires diligence to set up and run. There's compliance requirements, like a rules of the game. If you break them, there's serious penalties. And then there's an annual audit required by a third party as well. So, yeah, I don't think this should be taken lightly. It's not like once you sort of get an understanding of what the requirements are, and you've got a half-decent advisor who can help you through this stuff, I don't feel like it's too crazy. But again, if your expectation is you just hit a button and it's all done, that is not the outcome. All right, so now we're switching gears from engagement to family fund. And what I mean by family fund is that you're able to have more than 2 members in your fund. So you could have your kids in it. I'm not saying it's a good idea, but you could have your kids in it. You know, other family members, brothers, sisters, your parents. And as of 1 July 2021, you can have up to 6 members. That number used to cap out at 4 previously. But be careful, things to consider is the 3 Ds. So what happens if one of those people die and the estate planning or control requirements there, or one of the members becomes disabled, or one of the members becomes divorced, and that can kind of be tricky to unwind. So, so I just think we need to be careful thinking about having any more than, let's say, yourself and your spouse in your SMSF. I feel like there's a reason why the average members per fund is around that 2 mark. I think you're pretty brave if you want to have 6, because there's requirements to be fair and equitable to every member. So, if things go bad in the family, then that might be challenging. Cool. More people equals more decision makers. We can reduce this risk with what's called a leading member fund. So almost like appointing a chairman in a sense of the fund who's able to sort of guide it on behalf of the members as well. So that's a special type of fund we can set up, or we can even convert an existing SMSF that's in place to this leading member fund. If you do want to have a bit more, or if a single person wants a bit more control over it, over the overall guidance of that fund. Alrighty, so that is the family fund section. Now we're talking about controlling tax. So this is one of our standard diagrams we do on the different tax rates between entities. So we've got individuals where you can pay up to 47% tax, companies, which is 25 or 30%, depending on what it does, a trust. It's not a 0% technically. A trust distributes its profits to other entities in the family group, and then they pay the tax. And then you've got superannuation, or in here I've got SMSF, where you pay 15% or 0% tax. So that is a genuine 0% tax rate though. And what I mean what I mean by the difference between, or why it's got two, is when you're growing your super balance throughout your lifetime, you're in what's called accumulation mode. You're growing your balance. You'll get taxed 15% on tax deductible contributions when you go into the fund. It'll be taxed 15% on its earnings when your super fund earns. And again, that's a lot less if we look back here than 25 or 30 or 47%, depending on what your individual tax rate is. But there still is a tax liability, even in super. Once you hit pension age, which you've met a condition of release, which typically looks like you're over 60 years old and you've retired, then you can switch gears into what's called pension mode, where the balance is taxed. Your earnings are taxed at 0%. Now, there is a cap to that. That cap changes every year. Started, I think it's around about the $1.7 million worth of assets that that the income is taxed on at 0%. Let's say you've got $5 million in your fund. You'll be taxed on the balance after 1.7-ish at the tax rate of 15%. So anyway, what I'm saying is people with bigger balances, let's say than that 1.7 mark, if you want detail on that, you'll need to get advice around it. Jermaine has asked, what's the tax rate in accumulation mode in a standard super fund? So that's 15% as well. So there's no difference in these tax rates between an SMSF and a non-SMSF superannuation account. Cool. Benefits of drawing a pension, I kind of mentioned that. Tax-free investment profits, tax-free capital gains tax too. So let's say you buy a property in your fund now and you wait till you're retired and over 60 to sell it, and you're drawing a pension, then the gain on that could be tax-free. Cool. All right. The other thing as well, a bit of a giveaway if you're interested, is a bit of a spreadsheet I put together comparing investing in a bucket company. I'm not going to go into the detail on what that is in this webinar. We've got tons of content on that stuff, but it's basically investing in making an investment through a company versus accumulation phase in super versus pension phase. Now, what this graph or this table shows is a starting investment amount of $100,000, and then each year adding 55K before tax into each one of these structures. So in the bucket company, you got the 55K coming in and you immediately lose 30% of that. And it's earning 8% return annually. And that's what the forecast looks like with the starting balance plus the ongoing investment and what it earns at 8%. So in 10 years' time, we're looking at 670K. Now, just because of the reduction in tax in an accumulation phase, you are 162K better off under the same starting investment and ongoing investment because of just this halving of the tax rate, and then 0% here. So it's not 0% tax of your contribution here, because your contributions still need taxing if it's a tax deductible one. So I feel like I'm saying a million words in 1 minute, but hopefully you're keeping up. So with pensions, it doesn't mean 0% tax when you put money in as a tax deduction, but what it does mean is 0% tax on your earnings in super. So that 100 grand earning 8% is taxed at 0%. But when the 55K goes into the fund, you still pay a 15% contributions tax. But over the 10 years, your pension, being in a pension, is 222 grand better off than being in a bucket company. So again, super is sensational. So Howard's asked a great question. How do you contribute if you're in pension phase? In super funds, you can actually have multiple accounts. So let's say you put 55 grand in between you and your spouse, but you're already drawing a pension. Literally how we do that in the software is treat that as a separate account under your name. So you'll have a pension account and an accumulation account. And we can also have the ability, literally the day you put that contribution in, to turn it into a pension. So you've actually got two pension accounts. So it can happen where you can be drawing a pension and also contributing at the same time. Cool. All righty. Now, another thing that you do need to keep in mind is that an SMSF, self-managed super fund, does need an investment strategy. The things it should consider is the risks of the investments, diversification, and benchmarks for classes of assets. So it doesn't mean you have to make sure that you're split into 10 different investments and all this sort of stuff, but at least you've considered diversification in some way. You've documented why you've made decisions around the investments you've invested in, and also setting benchmarks. So, which usually looks like ranges that your SMSF should have in its investment mix. For instance, let's say you own one property and a little bit of cash. That would look like, let's say, a range of 80 to 95% invested in property with 0 to 15% invested in cash. That's sort of simple in that benchmarking. So the percentages might move depending on the cash balance and the value of your property, but we kind of need to be diligent in making sure that that's at least thought through, and we've got some documentation around it. Intended returns on investments, documenting any borrowings or even the thought process of, yes, we are okay borrowing in this fund, insurances, and then liquidity and cash flow requirements. So if you need to pay pensions, because there is a minimum amount you have to withdraw if you're drawing a pension, you need to make sure that the investment strategy accounts for it. Now, it's not set and forget. Our recommendation is to review it every year. It is something that we can assist you with, not in the development of it. We can't recommend your investment mix. That's the role of a financial advisor if you want one. But if you come to us and say, here's the range we want, we've got the ability to prepare this document based on templates that we have access to. Alrighty. So MP has asked a question. Can you address personal use issues? Yes, I will, actually. Yes. That's a great segue. So MP, can you, if I don't answer your question here, can you just clarify further where you want me to go with this? But literally the next slide was about in terms of your investments, you need to make sure that they are permitted under the trust deed, so the actual SMSF trust deed. Then you need to make sure they're not prohibited by the SIS Act or the Superannuation something or other Act. And it also meets the sole purpose test, which is your fund needs to be maintained for the sole purpose of providing retirement benefits to your members or to their dependents if a member dies before retirement. So that means we can't just buy a residential property and go and live in it as our own house, or even another family member. Let's say you want to buy a house for your brother or sister to live in. Can't happen. There's definitely rules around that. Okay, so MP said, if SMSF partners with personal money to make an investment. Okay, so you've got money in super and outside of super and you want to do an investment. Is that what you're kind of asking? Correct. Yes, there are structures that where we can make that happen. Absolutely. There are a lot of rules around it if it's just your own family. In short, if you want the accounting lingo or term, what you're talking about there is a Regulation 1322C trust, which can, let's say, it can invest in property, but you can't have lending on that property. So yeah, if you want to, we can connect offline and debrief or run through whatever scenario you're looking at. But, yeah, it technically is possible with additional structures. And we've done it quite a few times before. Cool. All right. Now switching gears into leverage. All righty. So an SMSF cannot borrow to buy property directly, which is kind of confusing. So if you hear that SMSFs can't borrow, technically that's true, but practically there's another way to do it. So what we do is we create this bear trust that sits in the middle of the property and the SMSF, and the bear trust can actually borrow from the bank. That's all above board. It says shadow here. It's just a term. It's all legit, but you borrow the money from the bank, or you can even borrow money from your own entity. So MP, this is another way to do it, where your ownership is in the SMSF, and your personal money outside of super can be lent in through this lending arrangement. Cool. Now, I've taken these slides from a webinar we did with a mortgage broker. So I'm not a mortgage broker, but these are high-level things to consider when you're looking at leverage or the difference between lending inside and outside of super. In your own name or a company or trust, this is outside of super. It's a less complex lending structure, so you don't need this bare trust thing. It is a higher tax outcome though, given your SMSF is taxed at 15 or 0%. Your business and personal income can be used to service it. Property outside of super or lending, you can adjust for existing rent if you will own or occupy. So yeah, if you're looking at commercial premises, for instance, you can use other security for your deposit. That's interesting too. So I'll compare that to inside of super or lending with this LRBA. Did I say that back here? Yeah, limited recourse borrowing arrangement. That's what LRBA means. It's the superannuation lending. But superannuation contributions, and so you can use your super contributions each year that you've been making and rental income to service the loan. So that's what the lenders in SMSFs look for. The tax at 15% or 0%. I've already mentioned all that. Limited choice in lenders. So there's definitely not as many lenders to choose from in SMSF versus outside. Typically a higher interest rate. The lender can require that you get advice and sign off. So this can be expensive, and sometimes they pull it out at the bloody last minute where they say, cool, we've approved the loan, but you just need to get legal advice and financial planning, which can be thousands of dollars. It usually is thousands of dollars or more to go and get those people to explain what you've probably already read before and sign off. It's the bank trying to de-risk themselves. This one here, you definitely need a cash deposit for this, whereas you can use equity usually in another property if you own it outside of super. And just on that point as well, you can't cross-collateralize inside super. There's no way I've seen, and I'm pretty sure it breaches rules. So you can't use, let's say you've paid off a whole property in super, you can't then go and draw on that as a deposit on another property like you can outside of super. So yeah, keep that in mind. You cannot borrow for construction costs unless it's off the plan. So what I mean by this is you can't have a contract for a land purchase and a contract for a build that are two separate contracts. With lending in super, you cannot borrow to construct. The other thing is, and this applies, I think, in states that aren't Queensland, but sometimes when you're buying apartments, you'll get a contract for the actual apartment separate to the contract for the car park. I know this sounds really silly, but if they're not a single contract, then we can't lend for that in super. Lucky Queensland's a bit different, and we've, I think it works off a license to use a car park rather than a separate contract. Alrighty, deposit required. Again, this can change all the time, but from my chat with the mortgage broker, he reckons between 20 and 30% is your deposit plus your stamp duty. And then sometimes you'll need 10% of the value of the property in liquid cash for the lender to be comfortable. So what that means is if your 20% deposit plus stamp duty uses every cent you've got in your super fund and you haven't got enough to, let's say, pay a tax bill or something else, they might want to see 10% of the property value spare after your transaction goes through. But again, like feedback from the broker is it depends on the lender, how much they'll lend. It also depends on the postcode and even the asset type and the price. So if you're looking at a $20 million building, I don't think they're going to go at this lower end of deposit, but all the ones I can remember in the last couple of years have allowed up to 80% loan values or a 20% deposit plus stamp duty. So it's pretty cool. Alrighty. Next one is insurances. Alrighty, so just check I've got it on the next page. So different types of insurances to consider are life insurance, TPD or total and permanent disability, and income protection insurance. So again, something I'd recommend massive amounts of advice before you go and do it. In fact, my recommendation is to get a financial advisor to take you through this whole process and choose the right insurance that's appropriate for you. But benefits, if you can have it cash flowed from super, or at least portions of your insurance that are paid from super. The common one there is life insurance. So that's not something you necessarily have to pay personally. Some insurers offer the ability to pay it from super. And also tax deductibility of life insurance in super as well. The downside to paying insurance from super is that it reduces your super balance, and then also the payment made to the fund and then dealt with. Okay, so what I mean by this is that when you're claiming on your insurance, you don't receive it personally. Your super fund does, because it's the one paying the bill and what they call the policy owner. That means that the super fund will receive it, and then you need to get it out from there. So if it's life insurance and you're dead, that means it needs to be dealt with under whatever estate planning that you've mentioned around what happens if you're dead. But if let's say you've drawn on an income protection insurance that's paid to super, you need to meet a condition of release to actually access that money. So anyway, that's a detailed conversation, but definitely one, I've never seen anyone do this without a financial advisor who does insurances. So please involve someone like that. Incapacity planning. So this is a situation where you're not quite dead yet, but you may have lost your marbles. And the guidance I've got for you is always have an enduring power of attorney in place. You never know when you might need it. And if you're already in a position where you're not, let's say, of sound mind or thinking clearly, or you're in a coma, and you need people to act on your behalf, and you don't have this in place, it's going to get pretty messy. Also, the superannuation fund requires all members to be trustees or directors of the trustee company. You can act under an enduring power of attorney for someone else, and they don't need to be a director. So what that means is, let's say my wife Stevie, she signs a power of attorney saying she wants me to be the director in her place, then that can be an outcome as well. You also need to ensure the trust deed and the constitution for your SMSF is set up to allow this in the event of incapacity. Cool. We are getting through this. So estate planning. So this is when you've passed away, the considerations you need to have. So the first one there is estate planning is not just a will. A will, in short, only deals with assets in your own name. So they don't deal with your superannuation. Superannuation proceeds after passing are dealt with ideally by some sort of binding death benefit nomination. So this is a document that you prepare, and it directs the super fund where your superannuation should be paid. Otherwise, it's dealt with under the trust deed, which, who knows, depends on your deed, depends on what that actually says. It can also be paid to your estate to be dealt with under the will. So I said your will doesn't deal with super. It can if your super pays your balance to your estate, but it's not guaranteed if you don't have it set up that way. And it also, I also hear that people are like, oh, I don't need a will, I don't have much assets. But if you've got $1 million life insurance policy and you die, there's $1 million in cash that goes somewhere. So again, you kind of need to consider both estate planning and insurances, and all of that stuff is better done with all your advisors knowing what's going on with everything. Cool. Alrighty. So that brings to an end the 8 benefits to run through. What I want to do now is just run through some case studies of SMSFs. I think I've got about 4 or 5 different ones. And and obviously the names and the values are crossed out, so to speak, and the values are rough values rather than to the cent. Cool. Alrighty. So we had a client who held a property outside of super. It was about 300 grand with a loan on it to a bank of 150K. So he had about 150 grand in equity in that property. He wanted to free up some cash personally, so he moved the property into an SMSF. There was a stamp duty cost for that. And he had enough in super to pay the 150K loan out plus the transaction costs. So he had about 170K in super. So the 20K-ish was a little bit of balance at the end, plus stamp duty, the setup fees. And then he was able to pay a deposit to himself for the purchase of 150 to clear the loan. And then the SMSF has a loan outstanding for the remaining 150K. And that's a vendor finance sort of arrangement where he lent his own SMSF cash, if that makes sense. So I've already said this. So his SMSF owes him 150 grand. So how that works is he pays rent and his 27,500 a year super contributions into his SMSF as a tax deduction, but he can take that money straight back out as a loan repayment, tax-free out of his super fund until the loan is paid back. So that'll be a few years of putting money in, and then literally he can take it straight out and reduce his loan. Alrighty, another one here is the double your super fund trick in a few years. So we had a client with a commercial property owned outside of super, about $1 million value. The client was shifting into retirement. They wanted to move money and assets into super. So they decided to move this commercial property in. They had about 300 grand in super, and the loan on it was about 700 grand. So it wasn't an owner-occupier property. That doesn't matter if it was, though. So they received a few years rent in their super fund, paying 0% tax. Within 2 to 3 years, they received an offer to buy that building. Someone else wanted to buy it for 1.3, and basically they sold that property for a $300,000 gain. And instead of paying 30% or more tax outside of super, they paid $0 or 0% tax on that gain. So from their 300K starting balance, 300K gain, and a few years rent in there, it was over a 600K fund only after a few years. Pretty cool. Alrighty, another situation we had was an IT business. So his business was previously renting and had grown pretty excessively through COVID. The owner had an opportunity to buy a property, like commercial property near his home. Purchase price was 300 grand. It needed a fit out, which was funded through prepaid rent through the business. So his business paid a year's worth of rent to his SMSF, and he used that to cash flow the fit out. The fittings and furniture were paid by the business itself to access the instant asset write-off. And the client is now paying a similar rent from his business, but instead of paying it to a third-party landlord, he's paying it to his SMSF and paying off an asset. And he's in control of his business premises, which can be handy for long-term security. Alrighty, another example. Now, MP, when I talked about the Regulation 1322C trust, this could be an example of that. I don't think this exact trust is one of them, but we could get a similar outcome here. So there's 4 business partners looking to buy an office space for their business. They all had SMSFs, and they all had about 200 grand or so to put a deposit down. Now the property was valued around 750K. So we used an ungeared unit trust because there was no borrowing. And each business partner owns 25% through units in a trust. And the trust, no borrowing, the trust owns the property outright. Cool. And all 4 business partners are unrelated. So they're not brothers and sisters, so to speak. Alrighty. So we've also got the last case study here, which is a home office to premises. So we've got, in this one, we had a service business in the building industry, also had grown through COVID. An existing home office was hitting its limits with team members and uncomfortable with a baby on the way. The client purchased an 800K property not far from their home, and it was about a 75% LVR loan to value ratio. It needed renovations funded in super from other cash in the fund, and the furniture was paid for by the business with the instant asset write-off. That old gem, which is ending in 7 days. Or the full expense write-off. Cool. And the client now has a lovely shop front to take the business into the next stage of growth. And I mean, property prices have definitely increased since, but the renovation definitely helped that as well. So yeah, we've got, I mean, these are just a handful, but we've got case study after case study of how people have used SMSFs. And you can see that, you know, in a lot of these cases, it actually benefits the business and the growth of the business as well. Alrighty, another question that also comes up is how much does it cost to set one up? So this is our pricing. So for a setup of a fund, we charge 3.5K plus GST to get that set up. And then the ongoing management, this can vary, but the price is from 275 plus GST. So if you've got BASs to do, or you've got pensions and things, that the price obviously goes up as a result because of the additional complexity. It also includes the ESA. So this is a new requirement, probably the last few years now. It's called an electronic service address. But what happens there is this is like the communication channel with our SMSF software and the ATO's reporting, and how your employers also send contribution information to your fund. So you need basically an electronic address that your SMSF is registered at. And yeah, our price includes that. It's built into the software. All the financials, tax returns. There is an online portal if you want to have the ability to look in and see what your fund reporting looks like mid-year. And also, if you've got basic questions around you know, what you can do, then we do include that, unless it's something like a massive property development or big business structure, where we may charge for the advice around that, depending on what it is. So this is our starting ongoing price. And then the other thing to keep in mind is your annual audit. So all SMSFs need an annual audit, and that is usually 350 plus GST. It can be more if for a more complex fund, or if you've breached the SMSF rules and there's additional reporting that the auditor is required to do to tell the ATO that you've been naughty. Alrighty, cool. Well, that brings to an end our content. I've got time for questions in a moment, but just a reminder, if you do want to explore working with us as your accountants, then please book in for a strategy call using this link here or in the chat box, QR code, whatever you want to do. Also, our next webinar will be on the 12th of July, where I'll be pairing up with Sean Sewell to teach us how to go from stuck to freedom in your business. So check that out if you're keen. And then time for a bit of Q&A. Alrighty, so I'm just going to open the chat box a bit bigger. Alrighty, Kanishka, I probably wouldn't recommend having kids under 18 as SMSF members. Yeah, I'd have to look into the requirements around directorships, but I'm pretty sure you can only be a director over 18. So yeah, that's like, and I don't see it at all actually with SMSFs. Not saying it can't happen. I'd need to look into that. Hila, if Inspire does the ongoing management, I assume someone else needs to do the audit. Absolutely. So we've got a third-party auditor that we work with, where they review basically our work paper packs and what the client has supplied us, and then they sign off on the audit for sure. Cool. I can't see any other questions. Actually, Howard's asked, I think this was right back at the start, any stats on the mix of super assets? No, I just looked up some of those high level stats with the ATO. I didn't go into sort of what they were invested in. Any issues with SMSF members in pension phase being based offshore? So I have had this a couple of times. The last time I looked into it, from my memory, is that you definitely need onshore people in the fund. If you've got one person living offshore, I'm pretty sure there is a test potentially around the member balance. So yeah, again, this is too long ago for me to formally give advice on, but I'm pretty sure that there's a rule around what percent of your members funds are members based offshore versus onshore. And I think there's like a 50% test. So you have to have 50% or more of the people based in Australia. But there may be other ways to deal with that around who's the trustee, potentially even looking at power of attorneys and things like that. Yeah, again, pretty high level custom advice there that is needed. Can you add your parents into your SMSF? Yes, if they recently got their permanent visa approved and arrived in country. Or Rajiv, I am not sure on if it's a I'd say, yeah, a permanent resident, a PR, should be able to be an SMSF member. I'm just not sure what type of visa that is. Ahila, can overseas property be transferred to an SMSF? We live in Australia. So with transfers from your personal names or related entities into super, there's basically a blanket exclusion, and the only exceptions are market listed shares and units in unit trusts, or commercial property, commercial real property. So my thoughts are probably not for your question. All righty. Cool. All right. All righty. Well, that seems to be all the questions that are coming through. I'll still stay on here for a couple of minutes, but apart from that, thanks everyone for joining, and hope it was educational and you got what you wanted. If you're a client who's online today, please reach out to me or your accountant that you work with if you've got further questions as well. Yeah, hope everyone enjoyed it.